When it comes to investing, you're unlikely to find any hard and fast rules that apply everywhere. There's always exceptions and caveats. But if I had to pick a rule that's as close to absolute as you're likely to find, it's that risk and reward go hand in hand. You can't expect to get higher returns without accepting higher risk, nor can you expect lower risk without accepting a lower rate of return. In this low interest rate environment, some people are often tempted to look for investments that offer better yields than what they're getting from, say, money markets or CDs. It's a phenomenon known as chasing yield. The problem is that they're often unaware of the inherent risks in doing so. Where bonds are concerned, higher yields can be potentially achieved in two ways. The first is by taking incremental maturity risk, which leaves you vulnerable to rising interest rates if unexpected inflation heats up. This can increase the volatility of your portfolio in a big way. It's true that market pundits have been wrong for several years now about higher interest rates on the horizon, but that doesn't mean they'll never go up again. When interest rates rise, the value of your bonds go down. And the longer it is until the bond matures, the more volatile its current value can be. The second method of chasing bond yield is to take credit risk, where you could lose money if the bond insurer fails to make timely payments of principal and interest. This is often correlated with the risk of owning stocks, because during stock market downturns, ideally, you want your bond investments to help cushion the impact of losses. But if you own lower quality, high-risk junk bonds in an attempt to prop up your rate of return, you won't get any offset during these volatile market periods. When interest rates are low, some investors are drawn to high dividend-paying stocks to provide them with some cash flow. But stocks that offer a high yield may signal a company that's actually in distress. In other words, the yield could be high because the share price has fallen due to financial troubles, but the company hasn't yet cut its dividend. Having a higher yield doesn't help much if the value of the stock is going down. If you're going to own dividend-paying stock, it may be better to reinvest the dividends than take them as income. Instead of being drawn in by the lure of high dividend yield, consider maybe these companies that are growing their dividend at a healthy rate. Some may only yield 3 or 4%, but if that dividend is growing by, say, 10% a year due to fundamentals, you might be looking at a much better stock. Just remember that none of these things are guaranteed. Now, there's no shortage of headlines and websites telling you where to find high-yielding investment opportunities. But before you jump in, keep in mind that yield chasing rarely ends well. Whether it's stocks or bonds, once a point of inflection happens, it's then just a matter of who's left holding the bag.